This is Duke University.
Good morning, everyone, and welcome to this edition of Fuqua Faculty Conversations. My name is Scott Dyreng, and I'll be taking your questions today and talking a little bit about corporate taxes. I have with me today one of our PhD students, Robert Hills. So welcome, Robert.
Thank you.
And Robert will be asking questions today and helping me with our conversation. As most of you know, I've been here at Fuqua for since 2008, and my research focuses on corporate tax issues and the way companies respond to the policies that our government enacts. And just as a reminder, throughout our conversation today, we would be happy to take your questions. You can submit those questions via Twitter using the hashtag FuquaAlumni, or you can email those to conversations@fuqua.duke.edu. And we look forward to hearing your questions, and we'll do our best to answer whatever questions you might find important. To start off, Robert is going to take over and ask a few questions, and we'll discuss them. So Robert, take it away.
Thanks. So the first question I have, Scott, I've heard a lot about the U.S. potentially switching over to a territorial tax system, as they currently have a worldwide tax system. And I want to know, what's the difference between the two systems, and why are so many people interested in it right now in that discussion?
Yeah, so there are, especially with the presidential politics starting to heat up for the next election, there's a lot of discussion about corporate tax reform, and one of the big issues is the potential to adopt a so-called territorial system. And to really understand what this is, we need to understand the difference between a worldwide system, which is what the U.S. currently has, and a territorial system, which is what is sometimes proposed by different people. So a worldwide system, which is what the U.S. currently uses, is a system where the U.S. claims the right to tax income that a company earns regardless of where in the world that income is generated. So if the income is earned in France, the U.S. says it's okay, it was earned in France, but we want to claim the right to tax that income. If it's earned in the U.S., they tax it. So it doesn't matter where you earn it. In recognizing that a company might be taxed multiple times because France may also say that they want to tax that income, the U.S. then gives credit for taxes paid to other governments. And so a worldwide system essentially says we'll tax everything that you earn no matter where you earn it, but we will give you credit for taxes that you pay to other governments. In contrast, a territorial system is a system where the government says we will only tax income that is earned in our country. And so if the income is earned in the United States, it's taxed by the United States. If it's earned in France, it's taxed by France. And the U.S. doesn't worry about trying to tax any residual that might be owed after you've paid tax to France. So those are the big differences between the two systems. There is one caveat that's important to understand, though. The U.S. tax system is not a pure worldwide system. There's a big issue that is also associated with our worldwide system, which is the notion of deferral. And that is that if you earn income in a foreign country and you owe some tax to the U.S., even though you have that liability, you don't have to pay that tax until you return the cash to the United States. And so you can defer the payment of that tax, perhaps forever, and thereby potentially save tax if the time value of money is valuable. So that's the major difference between territorial and worldwide.
And is the U.S., are they unique in having a worldwide system, or is that common among most nations in the world?
Yeah, good question. So it turns out that among developed nations, the U.S. is one of the few that still have a worldwide system. And most developed nations have adopted a territorial system. The UK was one of the last developed nations to change from a worldwide system to a territorial system, and they did that within the last 5 years. But really, the U.S. is the last major country to retain a worldwide system.
What would you say are some strengths or weaknesses between territorial and worldwide tax systems?
So the idea behind a worldwide tax system is that it is what is called capital export neutral. And the idea behind capital export neutrality is a dollar invested in the US will be taxed at the same rate as a dollar invested abroad in some foreign country. And that can be a good thing because it would, in theory, lead to a situation where US companies are indifferent between investing at home or investing abroad. On the other hand, it can lead to some negative things, especially when you introduce deferral. Because our tax system has deferral, that capital export neutrality sometimes breaks down and it leaves companies with an incentive to leave their foreign earnings abroad and potentially then invest abroad more than they would invest here at home. In contrast, territorial systems are designed to be capital import neutral. And the idea there is that every dollar invested in a certain country is taxed the same, regardless of where that dollar came from. And that can be great because it doesn't distinguish between foreign investors and domestic investors. But on the other hand, it can give companies incentives to artificially shift their income out of the home country and have it be recognized in the foreign country, because if that income is saved, it can be, the tax savings are permanent as opposed to temporary and only arising because of deferral.
Okay. One other question that I have, I think is related to the worldwide tax territorial system, is a tax holiday. I've heard that in the news that the U.S. had one number of years ago. There have been proponents that want the U.S. to have another tax holiday. What is a tax holiday? Why are there proponents for that?
Yeah, so in 2004, the American Jobs Creation Act allowed multinational firms from the U.S. to return their foreign earnings and essentially pay a very low U.S. tax rate. So instead of paying a tax rate of 35%, they had to pay a tax rate of about 5%, or they got an 85% deduction, so a 5% tax rate. And this was a really big incentive for firms to return the earnings that they had stored up in foreign countries to return them to the United States. And in fact, about $320 billion or so was returned to the United States during this holiday in 1 year. So that's a lot of capital being returned to the United States. One of the problems with a holiday, though, is if you give somebody a holiday one time, they want another holiday. This is like when I give my kids a popsicle. One is never enough. They always want another one. And it turns out that there are many firms that are currently lobbying for another holiday so that they can return that cash at a low tax rate or tax-free. And most estimates are now that there is as much as $2 trillion being held offshore as firms hope for a holiday where they can return those trillions of dollars at a very low or tax-free rate.
And do you expect that there will be another tax holiday in the near future?
My suspicion is that the U.S. learned its lesson, and it realized that this experiment, though successful in returning a lot of capital to the U.S., was not as valuable as they thought it would be in terms of stimulating investment. So people who have studied the effect of the 2004 Tax Act, they examined what the companies did with the earnings that they returned. Yeah. And the idea was that if the companies bring it back to the U.S., they will use that income to invest in U.S. factories, to invest in employment of U.S. workers, to engage in research and development, and to pay down debt, and so forth. It turns out that what really happened was companies brought that cash home, and they used that cash for those purposes that we just discussed. But they took the cash that was already earmarked for investment in new factories, and they paid that back to shareholders, mostly in the form of share repurchases. So the major change that happened with all this cash was shareholders got big payouts in the form of share repurchases. Some have said that went against the spirit of the law. Yeah. Others argue that returning cash to the shareholders is a good thing to do because then the shareholders can decide where is the most efficient use of that capital and they can redeploy it to other productive uses. But in general, I think because it didn't create a massive impulse of U.S. investment, that the politicians don't have a very strong appetite to repeat that experiment.
That makes sense. Another thing I hear about frequently in the media is inversions, and they relate how that's related to tax. What is an inversion, and why is it such a big deal, or why is it frequently discussed in the media?
Yeah, so corporate inversions have been all over the news, especially for the past couple of years. In fact, many people have said we're in the midst of an inversion wave. And so what an inversion is the following. Maybe if I could get you to pull up slide number 3, we'll take a look at a little figure. So in this figure that you can see on your screen, you have a U.S. company that has 2 subsidiaries. One of them might be in a high tax country, like, as an example, Germany, and the other might be in a low tax country, like Switzerland. In an inversion, what happens is there's an exchange of shares, so that if you'll go to slide 4, the shares of the U.S. parent are sold to the Swiss subsidiary, and the Swiss subsidiary gives its shares to the shareholders. If you'll go to the next slide, on slide 5, what you'll see, once all of the shares have been exchanged, the Swiss company now becomes the parent company, and the U.S. company becomes a subsidiary. And so what's happened in this situation is the company has basically been flipped upside down or inverted, turned inside out. That's where the term inversion came from. Back in the early days of inversions, really in the late 80s and early 1990s, this is how all inversions happened. And so the term corporate inversion came from this type of structure. But as you've probably read in the press, inversions are not very politically popular. Yes. And even beginning back in the early days of inversions, in response to these transactions, the government would issue what they often called anti-inversion rules. And as time has gone on, those anti-inversion rules have become more and more complex, until today, if you want to engage in an inversion, you can't simply sell your shares to your own subsidiary. You have to essentially have a merger of equals. And so this year, this past 18 months, the inversion wave has basically been a series of large companies merging and combining, and the combined company locates their parent company in a low tax country. It turns out the real benefit to an inversion is not so much having your parent be in a low tax country, though, as it is having your parent be in a territorial country. What the companies are really trying to achieve is they're trying to achieve a territorial system. So one way to think about tax inversions is it's do-it-yourself tax reform. It's trying to adopt a territorial system on your own because our U.S. government isn't doing it for you. And so by adopting a territorial system, these companies can then pay the tax that they owe to the U.S., but they don't have to pay the tax that they might owe to another country also in the U.S. One of the interesting examples is Burger King and Tim Hortons. When Burger King and Tim Hortons moved, they moved the parent company to Canada. And everybody said, oh, that's interesting. There's probably no tax reason for that because Canada has a high tax rate. But it turns out that Canada is a territorial system. And so it used to be that if Burger King sold a hamburger in Venezuela, it would have to pay Venezuelan tax and possibly U.S. tax on that hamburger. But if Burger King is now located in Canada and it sells a hamburger in Venezuela, it only pays the Venezuelan tax and it doesn't have to worry about paying U.S. tax or Canadian tax. That's the idea behind inversions.
And why, when I read in the media, why do they talk about inversion waves? Why have they come in waves over time?
Yeah, that's so I think what has happened is, usually what happens is somebody gets the idea to have an inversion. Mm-hmm. And they do a simple one like the one we illustrated here where you just exchange shares with your own subsidiary. When the anti-inversion rules are issued, it usually takes people a few years to figure out how they can work around those rules to accomplish the same thing. And it's a little bit of a cat and mouse game. So in fact, if you'll pull up slide number 6, you can see a list of anti-inversion anti-inversion legislation that the government has implemented over the years. And what you can see is happening is every time there's a wave, a new anti-inversion rule comes about, and then another wave, and then another rule, and another wave, and another rule. My guess is the latest rules, which were issued in 2013, which were designed to stop the latest inversion wave, will be only partially effective, because companies are very clever at designing ways to get around the system.
Okay. Another issue I hear frequently in the media is about tax haven countries, such as the Cayman Islands, Bermuda, and so on. Ireland, another example. What's the advantage for a firm to have some type of subsidiary or presence in those countries, I guess?
So if you look at the data, U.S. publicly traded companies, about 2/3 of them have at least one subsidiary, a significant subsidiary, significant enough that it must be disclosed, located in what many people would call a tax haven country. So you gave 3 examples: Bermuda, Ireland, the Bahamas, sometimes Barbados, Isle of Man, Jersey. There's probably 30 or 40 countries, most of which are very small countries, often in the Caribbean, places where you and I might like to vacation. It turns out that these companies are very commonly located in those countries. And many of these subsidiaries are really not much more than a piece of paper in a filing cabinet. So not long ago there was an article which suggested that there were over 15,000 businesses located at a single address in the Cayman Islands, which might suggest that not a lot is happening in terms of real substantial business activity, but it's more or less a paper company. So why do companies use these tax havens? Well, there could be many reasons. One reason is the companies will argue that it's a way for them to have efficient internal capital markets, so that they can transfer funds internally without having those funds caught up in the tax system of the multitude of countries in which they operate. Of course, another reason is they want to use these tax havens as a way to reduce their global tax burden. And in recent research essentially finds that companies that use at least one of these tax havens on average pay about 2% lower tax rates than companies that don't use one. How are they using those havens? They range from the very simple to the very complex. And so what essentially happens is companies are able to use strategic transfer prices, which is the selling and buying of goods within the company. There are prices that are set there, and you can set the price so that a high price is paid by the subsidiary in a high tax country, and the selling company that receives the high price is in a low tax country. This results in the profit all being recognized in the low tax country, where the tax rate is 0 or low, and all of the expenses being located in the high tax country. If you have all of your expenses and so no profits in the high tax country, you obviously don't have to pay tax there. And if you have all of your income in a low tax country, you don't have to pay tax there either. As a result, companies are able to strategically set these transfer prices in a way that allows them to avoid paying as much tax as maybe they otherwise would.
So if I understand, you're saying, for example, if we consider Bermuda a low tax country and the U.S. a high tax country, a firm would want to have all their profits in Bermuda and not in the U.S. to avoid paying taxes.
That's right. And if all your profits are in Bermuda, the Bermuda government, they don't tax it. So you don't pay anything in the U.S. and you don't pay anything in Bermuda. Now, of course, because the U.S. is a worldwide system, if you have profits in Bermuda, the U.S. will say, we're going to tax that. Okay. And so what a company must then do is argue that those earnings are indefinitely reinvested and not repatriated, and by doing so they can defer the payment of those taxes, possibly forever, and they can also avoid writing a tax liability on their financial statements because the accounting rules allow you to not record a tax liability if the earnings are designated as indefinitely reinvested.
Interesting.
Yeah.
So a current event that I've heard just recently this week is Etsy. They made headlines. They're trying to change their corporate structure so they have a subsidiary in Ireland.
Yeah.
What's the point of that?
So the Etsy has made a lot of headlines. I believe there was an article in the Wall Street Journal and the New York Times and in various places. Etsy decided that it would sell much of its intellectual property, intangible assets, to a subsidiary in Ireland. And by so doing, position itself to take advantage of the low tax rate in Ireland. The interesting thing about the Etsy articles were that they highlighted the pretty large costs associated with setting up this structure. So Etsy's most recent tax rates were much higher than expected, and that seems a little counterintuitive. But what happens is if the US company sells its intangible assets to its Irish subsidiary, that sale will result in taxable income to the US company. And if the intangible asset was priced exactly correctly, the company would gain nothing by sending its assets to Ireland because it would pay tax on the market value of the asset. But it turns out that intangible assets and intellectual property is often very, very difficult to value. And so the IRS and Etsy probably settled on a value, and Etsy paid the tax, sent the property to Ireland, and I think what Etsy is probably hoping is that the property turns out to be more valuable than the IRS thought it would be. And in the long run, they will be able to save a lot of taxes by charging other companies for the use of those intangible assets that are now owned by the subsidiary in Ireland. But this is making headlines because Etsy has tried to sell itself as a very transparent, very open company, and by going to a tax haven, they are now forced to operate in a world that some claim is a little more opaque and a little more clouded. So it's a little counter to Etsy's culture.
Makes sense. In all these examples, though, it seems there's a large incentive for U.S. multinational firms to attempt to create subsidiaries abroad or in tax haven countries or wherever they can pay a lower tax rate. Why is there such a high incentive, or why does the U.S. have such a high tax rate that all these firms want to leave the U.S. for business?
Yeah, so in 1986, the last time the United States reformed its corporate tax system, the U.S. tax rate was very high. And in that time, it was lowered down to about 34%. And it's stayed essentially at that level ever since. At some point, it was raised to 35, but 34%. When that happened in 1986, the U.S. rate dropped below the rate of most industrialized countries. And if you'll go to slide 2, I'll show you a brief figure that illustrates this point. This figure starts in 1988. In 1988, the average of the OECD, which is essentially most developed companies or most developed countries in the world, their average tax rate was 44%. So when the U.S. dropped its rate to 34%, the U.S. rate was really, the U.S. was in some sense a tax haven. The U.S. has essentially not changed its rate since that time, but every other developed country in the world over time has dropped its rate so that now the OECD average rate is 25% and the U.S. rate is still 35%. The bigger that gap gets between the U.S. rate and the foreign rate, the more incentive firms have to establish a tax haven and to shift their income to a low tax country.
So in essence, if I understand correctly, in 1986, the U.S., there was a tax incentive to have business in the U.S., and now it's switched, and there's a tax incentive to leave the U.S. for business.
That's exactly right. So as time has gone on and other countries have dropped their rate and the U.S. has failed to respond, our country is now unfavorable relative to other countries, whereas before it was favorable. That's exactly right.
Looks like we have some questions from some of our viewers. First question's from Stephen Lewis, who's from the MMS program and graduated in 2010. And his question is, what are some of the topics you hope to tackle in your future research?
Yeah. Well, Stephen, it's good to hear from you, and I hope things are going well. I'm surprised to hear you're down in Paraguay, but it's a beautiful area down there. I spent a lot of time down in Chile, so I love the Latin culture, and I hope everything's going well with you. So the big area and big push right now in terms of research is trying to understand and measure and estimate how much companies are actually shifting income from one country to another. So if you look at a US firm, choose your favorite, say Google, they want to strategically arrange their affairs so that their income ends up being recognized in low tax countries as opposed to high tax countries. But measuring how much income is actually located in a low tax country relative to how much should have been located in the low tax country is very difficult, because by definition, the firm only tells what it actually reported, not what it should have reported had it not had a tax plan. And so a great deal of my energy recently has been focused on how to estimate what the income should have been had there been no incentive to tax plan versus what was actually reported, and the difference is some estimate of how much income was artificially shifted. This turns out to be really important from a policy perspective, because we can then address questions like how much more income would be shifted if the U.S. were to adopt a territorial system as opposed to its existing worldwide system, or how much income is being shifted and how much tax could be gained if we change the tax policy to tax foreign earnings. So there's a lot of research to be done in that area.
All right, and I think a follow-up question from Stephen, he asked, does it make sense to only tax companies based on where they are located? Is that simpler, or would it be more, or would it add more problems?
Yeah, it turns out it's very hard to figure out how exactly to tax any company, and this is becoming even more and more complicated as the world has become more and more global and more intangible. So a simple example might be to take, for example, an iPad. An iPad is probably designed in California. It's probably manufactured in, at least in part, in China, and it's sold all over the world, say down in Paraguay. So if we're down in Paraguay and we purchase an iPad, the Paraguayan government might say, hey, we should be able to tax the income that's generated by this iPad because we provided the customer. And the Chinese government might say, we want to tax the profit generated by this iPad because we built it. And the American government might say, we want to tax the profit generated by this iPad because we developed the idea. And so there's great controversy in all of really the world right now about where it makes sense to locate the profit. And in some cases, it turns out that multiple countries claim the right to tax, and the company actually has to pay tax twice. And in some situations, it turns out that no country claims the right to tax, and nobody taxes the profits. From the company's point of view, of course, it wants nowhere income that nobody taxes. Of course, from the government's point of view, they want that to be taxed. So it's not clear if the income should be located, recognized where the company is located, where the sale takes place, where the product is manufactured, or where the idea is developed, or some combination of those things. It's becoming more and more of a challenge as the economy becomes more and more intangible.
Okay, so I know you referenced that a company could be taxed essentially twice from two different nations. I hear the term double taxation with corporations. Is that the same thing, or how does that differ?
Yeah, a little bit different thing. So the double taxation that is most commonly referred to is when a corporation is taxed and pays corporate tax, and then subsequently pays a dividend to its shareholders, and they pay a dividend tax. That's the double taxation that is usually being referred to. A tax at the corporate level and a tax at the shareholder level. The double taxation that I'm talking about is sometimes a corporation will pay corporate income tax to France on $1 of earnings, and also pay corporate income tax to Germany on $1 of earnings, and possibly even then some to the United States. So it can be, there can be many layers of tax. In theory, countries have developed treaties that mitigate the possibility of this double or triple taxation, but those treaties don't always work out exactly as the companies and the countries would like them to.
Okay. One last question that I had today is, I know a lot of firms are incorporated in the state of Delaware. What's that incentive? Why are so many firms, why do they decide to incorporate in Delaware specifically?
Yeah. If you look at publicly traded U.S. companies, and I think this is true even for non-publicly traded companies, over half of them are incorporated in the state of Delaware. And the reason that this happens, it turns out, is not a tax reason, but it's a legal and a governance reason. Delaware, the state of Delaware, has a very special, unique court system that's designed essentially to help firms operate efficiently. And so it makes it an easy place to do business because you can organize quickly and efficiently. You can litigate things in a court system where the case law is very well established and it's very predictable. And so it makes it a convenient and an efficient location for your parent company to be located. It turns out, though, that subsidiaries are often also incorporated in Delaware. And the case law is not so important for subsidiaries because subsidiaries don't have to worry about things like hostile takeovers. They only have one shareholder. It's the parent. Nobody's going to come and take them over. They don't have to worry about shareholder lawsuits because they are the only shareholder. So it was a little bit of a mystery why all the subsidiaries were organized in Delaware. But it turns out there's a tax explanation for Delaware subsidiaries. It's similar to the story that we were telling about the other tax havens like the Cayman Islands or Bermuda or the Bahamas. U.S. companies often have a subsidiary in Delaware that owns their intangible property, something like a trademark. So, for example, Home Depot has much of its intellectual capital, its trademarks, its name brand, and so forth, located in a subsidiary in Delaware called Homer LLC. And in theory, what could happen then is each time somebody buys a piece of hardware at the Home Depot in, say, Alabama, the Alabama Home Depot might pay a royalty to Homer LLC, which is in Delaware. That would increase the expenses in Alabama, which would reduce the income in Alabama and reduce the state tax that you would pay in Alabama. And it would create income in Delaware. Well, the Delaware state tax rate is actually quite high, but Delaware does not tax income if it was earned on an intangible asset outside of Delaware. And so that income would flow to Delaware and would be tax-free in Delaware. As a result, the company could essentially lower its Alabama tax rate and not have to pay Delaware state taxes, and overall the company then saves taxes. So it's a similar game as the Cayman Islands, Bermuda, Bahamas, Ireland game, but it's played at the state level as opposed to the multinational level.
Well, thanks. That's all the questions I have today.
Well, great. It's really been a pleasure to be here with you, Robert, and I've enjoyed talking with you about these issues that are, in my opinion, very important and will really have a big impact on our society as we move forward, especially with a presidential election right around the corner where many of these issues will be debated and discussed. And I've really enjoyed speaking with you and having the opportunity to talk with you former Fuqua students, and I hope that you found our conversation useful. There will be another Fuqua Faculty Conversation in October, and we will send information about that as we receive it. I look forward to speaking with you again in the future, and hope you'll feel free to reach out to me if you ever have additional questions.